All right, we're picking up on the pension and post-retirement benefits chapter, class goal number 4. We want to talk about unexpected gains and losses. And it really shouldn't be called unexpected because the reality is when you use an estimate, the actual is going to be different, right? Almost every time. As good as you are, your chances are that you're not going to be able to predict exactly. So there are unexpected gains and losses, but these are large, right? And so the way that this works is that managers worry about the unexpected swings in asset valuation for the pension assets. So to avoid large swings in revenue and expense related to the pension, companies use expected return to calculate pension return that goes into pension expense. Don't use actual unless both are equal. So I'm just about to fill in that part, in this part, and this is a good question. So the FASB allows companies to smooth these gains and losses by using the expected return and actual gains and losses related to differences are reported in other comprehensive income. Actuaries determine or recommend rates of return and discount rates. Companies that rely on actuaries with solid reputations are allowed to accept their recommendations. So you're essentially using a third party here. And what they're saying is actuaries do this report and they're saying based on the past and what your asset plans are in the future, this is your expected return. And if those actuaries are reliable, certified, then the companies can rely on those. And even as auditors, we don't audit the actuary's report. We check with the actuary to make sure they are legitimate, certified, they have all the appropriate controls in place to do these, and we accept their numbers and put them into our system. So they can't do anything. Now, they do have some flexibility to work with the actuaries, obviously, to change it. And when they make changes, they really need to justify them, especially with their auditors, because if you have billions of dollars in pension obligation, just a 0.5% can really change what your interest expense is for the year. And we've seen interest rates fluctuate often, so you're going to also have gains and losses as well. But really, management can't control those, right? I mean, they can, to some extent, say, don't put this money in risky assets, but then they're not going to get a return, right? Prior to the recent run up in interest, what were you getting on a savings account or safe, in a completely safe investment? Right? Something so small that you really would hurt your business if you invested in that. You know, you want to have some cash available in that fund to pay the bills, but you can't invest in treasury bonds at a 2% rate. So you're investing in, you know, the stock market, which fluctuates. You're investing in the bond market, which fluctuates. You're investing in consumables, land. You know, they're invested in all kinds of things to diversify their risk and still earn a good return. So they're going to see swings. For the most part, they're not saying invest in this specifically. They're just saying, here's the fund. We have a fund manager. That person invests it to try to maximize the return and minimize risk. So the actuaries determine these rates. They work with management and they get a report, and the report is generally accepted by the auditors as long as it's done to the standards that the actuaries are required. And I'll make a note, the actuaries also help with the funding pattern. When should the company contribute cash or other assets to the plan? And they can use stock to put into their plans. However, if they're using their own company stock, they should at least recommend that they diversify some of the risk. So a good pension plan, if you're putting stock into it, will sell that stock and invest in other assets. Because if you're holding that as one of your large parts of your asset and the company fails, then the value of your investment is zero. And that's what we saw in the early 2000s. Enron lost $90 billion. And a lot of their employees, they had made millionaires because they were putting stock into their pension plans and 401k plans. Well, guess what? When your management is doing bad things, that stock becomes worthless, and all those people lost a whole lot of money. So you want to make sure that you're diversifying risks if you're managing it, a pension plan. Second here. Okay. So how do we calculate the expected return? And it's the fair value of assets at the beginning of the period multiplied by the expected rate. The difference between expected and actual is a gain or a loss that gets reported in OCI. Other comprehensive income, sorry, I should spell out. The FASB uses the term pension asset / liability. So pretty straightforward. When the actual return is greater than expected, is a gain. When the actual return is less than expected, it is a loss. So how do they deal with these losses and these gains? In an ideal world, your kind of randomness, you would hope, keeps that number relatively small. Like you're not reporting gain after gain after gain after gain, but because of the randomness in the world, you're going to have some gains and some losses. So that OCI should stay relatively small. However, including with prior service costs and prior service costs, sorry, are amortized over the life. This is amortized only when the gain or loss exceeds a certain amount. So set an approach where if the gains are, accumulated OCI exceeds 10% of the projected benefit obligation, or 10% of plan assets. Notice both at the beginning of the period. The amount that exceeds this must be amortized. And amortized means recognized in the financial statements. Sorry, I should have said after the plan assets, you can make a little note there. Use whichever PBO or assets is larger to calculate the 10% corridor. So I'll leave that up and we'll start to talk about example 7. And I'll walk you through that. Please take 30 seconds, a minute to read it carefully. And I'll leave that up there in case you need to catch up on any of it. Is everybody good with what they needed from this part? Can I scroll down? Okay. All right. So the way that I recommend going about this is to kind of create a chart like this, has your projected benefit obligation, your plan asset, then you calculate the quarter amount. And then if you have your gains or losses and your minimum amortization. So in that first year, and I'm just pulling these numbers from here, this is the beginning of period numbers. My projected benefit obligation was 1 million. My plan asset value was 900,000. And so I'm just pulling these here. And I'm going to do that for each year. $1.1 million, 2026, 1.6 million, 2027, 2.1 million. $1,450,000 and 2 million. Okay, so what we do is we look for the larger one of the two, and then we calculate 10% of that figure. So the first one, 10% of a million, 100,000. For 2025, we have 10% of 1,250,000 or 125,000. 2026 would be 160,000. And then 210,000. Everybody able to see how I calculated that and where I got those numbers from? Okay. So now we're going to be looking at these figures here and then the net gain or loss. Okay. So our accumulated OCI related to the gain or loss in 2024 is 0. And so we don't have to worry about the gain or loss. So in our next year, 2025, we have 165,000. Right, but it affects the next year, right? That's okay. And so we need to figure out the minimum amortization of the loss. And so here they have this, and we have to calculate and figure out, does that matter to us? And so here we have 165,000 minus 125,000. Right, the corridor. right? 125,000 is our corridor. So we take the 165 and we subtract the 125,000. And so that equals 40,000. And we have to divide that by the service years. And so there's 8 years remaining. In 2024 and 2025. And so that equals 5,000 per year. And I'm just putting a little tick mark in there so that you know to come down here and you can find that number. Okay, so now we're through 2025, and in 2026, or excuse me, the way they have this set up is 2025, we had a $40,000 gain. So at the beginning of the year, we now have in this column 200,000. And so how does that work? We had 165,000 minus the 5,000 that we amortized plus the 40,000. And so that now equals 200,000. Now here, we're over the corridor. So we take the 200,000 and we subtract it from the corridor, 160,000. And that equals 40,000. But now our service life has changed. So 2026 and 2027 is 11 years. So we divide that number by 11. And that equals 3,636. So our amortization, 3,636. Now we need to find our accumulated OCI. And so we had 200,000 to start with. We subtracted out 3,636 due to amortization. And here we have a loss now of 30,000. And so we subtract out the 30,000. And that equals 166,364. And so our new accumulated OCI 166,364. And so how much amortization would we have here? Right, none, because 210,000 is greater than 166,364, so we don't have any amortization. give me 1 second and I'll pull that back up again. Any questions on example 7? Okay, so let's take a look at example 8. And I've got the pension worksheet loaded up, so give me a second and we'll walk through that one. Okay, if there are no questions, we'll jump into our example here. And this is example 8. And you have, if you open yours up, you've got a handwritten one, or you can use one of the worksheets that I gave you, whatever you prefer. We're going to start with our balance, January 1, 2025. And so they tell us we have a projected benefit obligation of $1,960,000 and plan assets of $1,650,000. So our pension asset or liability is the difference. And it's $310,000 credit, so it is a liability. Okay, and now we have the 5 components. What are our 5 components of pension expense? Good. Service cost, good. Return on assets is there. Right, interest on plan obligation or projected obligation. And then we could have, let's take a look in this case. They have amortization of prior service cost. And then we have contributions. And benefits paid. And then we also have something else that's interesting here. So what do we have there that's listed? Right, we have a liability decrease. Okay, so let's go ahead and walk through these. The service cost says $133,000. Fortunately, we don't have to make any calculations with that. It's an expense, so we're going to debit it. That increases our obligation. And so we credit that. Our interest on our projected benefit obligation. We take our projected benefit obligation at the beginning of the period. We multiply it by the interest rate, which I'm going to see. They have settlement rate of 6%. So multiply it by 0.06. And that's also a debit. It increases our obligation. So that's our credit. Now, we want to use our return on planned assets, and we're going to use the expected, right? If expected is different, then you use the expected. And here, this is going to provide us with a return of 160,000. So it's going to decrease our pension expense. And so that's a credit. And that increases our assets. So you put it in as a debit. Now we have to amortize the prior service costs. So in this case, this is going to add 24,000 to our expense. And it's going to increase our, oh, I did that wrong. Sorry, it's not there. All right, we already have our prior service costs. Here. Our contributions in this case come out of cash. And so we have 143,000 credit, and that goes into the plan assets. And that's a debit. And then the benefits paid, we reduce our projected benefit obligation by 178,000. And we reduce our assets available by 178,000. And then we have our liability decrease. And so it's related to our OCI gain or loss. And so we have 211,000, and it's going to be an unexpected gain here. So this 211,000, oh, I'm on the wrong line, sorry. 211,000 is going to decrease our liability. So it's a debit to OCI gain or loss. And then a credit to, no, sorry, that's a credit. And then a debit to the projected benefit obligation because it reduces the pension benefit obligation. Okay, so now we have to go back and look at what is our return on plan assets that we reported. So we had the expected return. What was our actual return? You guys see the actual return, right? Okay. So we have to make an adjustment because our expected return was much higher, right? So we're going to go back to our expected return on plan assets, and we're going to have a gain or loss here. And so that gain or loss is going to be figured out based on what we recorded. So here we had minus, we had 160,000 that we recorded. We're going to subtract out the 108,000. That was the actual return. And so we get 52,000 here as a debit, which means we have to adjust that number for the actual return. And so I'm going to put a little note on here. I'm going to put ADJ expected to actual in the memo column. Okay, so now we can go ahead and we can sum these up. And so we have our journal entry equals and that's a net credit, right? A negative it comes out. And so now we have to calculate the ending balances. Because we want to find out what our liability is. So we sum up all of our transactions in the obligation category. And we get 1,821,600 and 1,723,000. And so we take our difference and we get 98,600. So in order to calculate our entry, I did that backwards. Let's see. Yep, I did that backward. And so this is going to be a debit. I know. There we go. All right, so we need this to be a debit to reduce our liability. So then we take our journal entry and we record pension expense. And that's the 114,600. We have pension asset / liability. The 214,000. Cash for how much we contributed. And then the last part would be other comprehensive income. $159,000. And then the last piece of it, other comprehensive income. And this is related to OCI. And that's 143,000. This is related to the gain or loss. And so what are our ending balances here? Prior service cost. Was 240,000 as of the end of the year. And so our ending balance is the 216,000. Sorry, I forgot to put that first one in. Super challenging, some of these. Any questions? Sure. And just remember that it should match this line here. So now I've got the group work, and I know we don't have enough time in class to finish this today. So what we will do is you guys have 10, 15 minutes today, kind of get through your groups, ask any questions that you might have. And then we'll give you guys like 20 minutes, let's say 15 minutes in the next class on Tuesday to finish everything up. Over the weekend. And if you have any questions, let me know. Yes. Yep. So for those of you who are online, this is the end of sort of the regular class, and we're moving on. If you'll notice, the notes on here have some information about what is reporting. It's really a lot to remember. So I just kind of made this sheet up for you, and you have access to it. You can use it during your exams. If you guys want to stay in the call and chat with each other, if you want to work on this, if you have any questions for me, if you want to pull this from the group project, we'll talk about it. I can answer questions for you. Otherwise, we'll talk about it on Tuesday. So you should be mostly complete, except for a few things on Tuesday. All right. Have a great weekend. Thank you.